there have been a wobble in the market in the last few days, and I think that reflects the concerns about the second wave coming through and maybe needing more stringent lockdowns. It's our view that over this next few quarters that you'll see a vaccine, and that economic growth will recover, and those things will support Germany, the DAX in particular, and German stocks, which, as you mentioned, are very cyclical in many ways. So they are quite dependent upon that. And if there are very stringent lockdowns, you get a painful second wave that lasts a period of time, then yes, that will be a negative.
I mean, it's very early doors on this, I know. So how do you think about positioning at this stage in those particular areas you like, given that so much of the near-term future is opaque?
It's tricky, isn't it? I completely agree. The risks, the tail risks at either side are quite large. Either you get a vaccine or the second wave isn't as powerful as the first one, and you don't need such stringent lockdowns, and there's an economic recovery which is pretty nice, and of course interest rates are very, very low, which is helpful. Or on the other hand, we get something more painful, as we did earlier in the year. Central banks have already eased policy. We've already had a lot of release of very easy fiscal conditions and extra government spending. So what more can policymakers do? So I do think that creates a lot of large tail risks. In terms of positioning, I think the investors and clients I speak to, many of them do feel very uncertain. You've had lots of crowding in the stay-at-home names, the tech companies in the US, for example. I really think for people to move out of that type of name, to move more broadly into cyclicals, into the DAX in particular, that you would need to see the economic recovery properly start to come through.
Let's have a look at what the strong euro is actually playing, what role the strong euro is actually playing, because one would think that this is actually weighing on an index like the DAX is, but you've been writing that this is not the case, right?
Yeah, look, I think that people worry all the time, particularly investors in Germany and the DAX, because of the preponderance of autos companies in there, manufacturers, chemicals companies, international companies. Germany itself is a big exporter. Its GDP is dependent on it. The euro, if it's strong, people do worry about it. I worry a little bit less because I think the strength of the euro reflects economic improvements that we've seen in Europe since the lows in March and April. So it's genuine strength reflecting better economic growth that you're getting through in Europe. And of course, that's a powerful positive for Germany because it means it's an exporter across Europe as well as internationally. So I think that's one thing that makes me worry a little bit less about the euro in terms of the impact on the DAX. The other thing is just you can kind of see the proof in the way that the markets move. I mean, yesterday the DAX was one of the weakest performers because everyone, as you were saying, was worried about additional lockdowns, weaker growth. The euro actually fell, but it didn't really help the DAX. It wasn't a cushioning factor. And I think that really the DAX, Germany, exporters, chemical companies, manufacturers, what they really need to see is economic improvement to get the exports growth come through, and that will override any negative you get from the currency. That all being said, of course, if the currency rises super rapidly, then that is a little bit of a danger on the negative side. But I think really over this next year, I expect it to be outweighed by stronger economic growth coming through.
Yeah. We're talking about financials being cheap for so many years almost, at least here in Europe. But now, as it stands, the gap in valuation between technology shares and financial stocks is the widest in 20 years. Wouldn't it be like also a protection against rising inflation to buy into banks right now?
I think it's interesting you mentioned protecting against inflation. I do think equities as an investment do protect a little bit against inflation. And that's the whole sort of suite of equities, not just the banks. But clearly the banks will benefit if rate expectations ultimately start going up. But I do think we're a long way from rate expectations going up. And even if there is a little bit of inflation that comes through in the next couple of years, most central banks are talking about looking through some of that inflation. The Fed has moved to average inflation targeting through the cycle. And they're very willing, I think, to look through a period of slightly higher inflation. So you're not necessarily going to get the rate rises that would improve banks' margins, even if you do get a little bit more inflation. So I'm a bit sceptical about that.
Good point, Sharon. I was going to quiz you on that, having also just looked at the Riksbank this morning, and I'm just seeing crossing the wires now, the average repo rate is seen in the third quarter of 2023 at 0%. So, yeah, what inflation at this point? Which begs the question, if the recovery is so slow and challenging at this point, what more are we going to see on the stimulus front? The market's so focused on the US and the fight in Congress about agreeing a further deal to support the economy, but it sort of makes you think, well, what about elsewhere? Are we going to be in another wave of fiscal stimulus from governments, say, in the next 6 to 12 months?
I do think more will come through, yes. I think that the Bank of England and the ECB will probably extend their asset purchase programmes. The Bank of England probably in November and the ECB maybe early next year. So we are expecting policymakers to extend those programmes further. I think they will remain committed to very, very low rates for a long period of time. The Bank of England, as well as investigating the potential of sending rates into negative territory. Again, so all displaying a commitment to that very easy policy for a long period of time. And then you're right, on the fiscal policy front too, I expect more to be done there. Also, remember, the recovery fund monies haven't really been dispersed yet. They're dispersed over a long period of time. So we've got a lot more fiscal to come through. I don't think we've had some, but we will have more. And I think on the monetary front as well, you will have easy policy for a long time with a big commitment to that and more QE.